Let's start the class. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Alright, meet again with the financial data analytic class. And for tonight's session, our topic is about financial data analytics using linear regression. What is the competencies that I want you to have after the class? First is that you know what is regression. What are the regression use case? What are the type of regression? What is linear regression? Whether this is single or multilinear regression. And then least square methods, R-square methods, and how to implement the linear regression using Python. So what is regression? Regression analysis is a form of predictive modeling techniques which investigate the relationship between a dependent variable and independent variable. The objectives of a regression analysis is to understand the relationship between dependent and independent variable. The relationship will cater about regarding whether this is positive relationship or negative relationship, and then whether the relationship is significant or not significant. So the relationship may be positive and significant, or maybe negative but significant as well. How do you know that the relationship is significant or not? If the p-value below 0.05 and t-statistic above 1.96. How do you know that the relationship is positive or negative? If the coefficient is positive, negative relationship if the coefficient is negative. So this is the big picture of what a regression is. This regression techniques is the most popular, yeah, among students, yeah, to see whether to conduct the feature selection. So if there is a lot of features on the independent variable, so maybe there will be multi-linear regression. So there is not only one, maybe 10 independent variable. By using the regression analysis, we can identify which variable which variable has a significant relationship with the dependent variable. So this is the concept of a regression analysis. The use of regression are to determine the strength of a predictor, how do you know the strength, whether this is significant or not? Whether this one, the p-value is below 0.05 and t-statistic above 1.96. And also forecasting, because the formula will be y equal to constanta plus b1x1 plus b2x2 and so on. Yeah? So we are going to forecast the y given the condition of x1 and x2, because the beta is already determined, not already determined. The beta, we get the beta within the output of the regression model. We will have the beta, but the x1 and x2 will be given after to forecast on the y. And also, we use regression to conduct trend forecasting. Yeah. What is the trend? Using whether it is positive relationship or negative relationship. Maybe the model will be constanta plus b1x1 minus b2x2. Which variable has the highest coefficient? If the minus having highest coefficient, there will be a big possibility that the trend will be downtrend, negative downtrend, because it is a big negative there on the coefficient. So this is the use of a regression. So within the type of regression, there is linear and logistic regression. There are two kinds of regression. Not two, actually there are 5, but the most popular two is the linear regression and the logistic regression. Linear, there will be single linear regression and also multi-linear regression. So in single, there will be only one independent variable, but in the multilinear, there will be multiple independent variable. In logistic, there also gonna be two kind of logistic regression: binomial logistic regression and multinomial logistic regression. We are going to discuss on logistic regression next week. So, what is the difference between linear regression and logistic regression? The core concept on the linear regression, it is using a straight line. So let's whether this one like this, the data, and then this is going to be a straight line. The data model using straight line. Y equal to C plus beta X. And in the logistic regression, it is using the sigmoid. Now, so we are going to discuss on that sigmoid model. And then on the linear regression, the data must be in a continuous variable data. What is a continuous variable data? Data like your salary, your age, your weight, yeah, that is a continuous data. Yeah, age 21, 23, 25, 27, 28. There is a continuous data. Salary 100 million, 50 million, 70 million, 85 million, continuous data. Yeah. And then, But on the logistic, using the categorical variable. Categorical, not a continuous. And the output is the value of the y variable. The output will be the value of the variable, the y. In logistic, probability of occurrence. What is the probability that the first category happen? And what is the probability that the second category happen if it is binomial? So we are going to discuss detail on this next week. The accuracy in the linear logistic regression is measured by loss, error, and R square. R square is telling us the representativeness of the output and data. And in the logistic is the accuracy, precision, and recall. The goodness of it, R square, adjusted R square, yeah, R square, yeah, R square. In the logistic, confusion matrix, RRC, curve, F1 score. Next week. So this is the basic concept of linear regression. Up until this slide, any questions before I continue? Yes.
I don't understand. The linear is different regression with logistic regression?
Different. Logistic, the result will be like this. 1 and 0. So maximum is 1, minimum is 0. Linear regression, like this. It can be negative. Yeah. So the result will be maybe positive or negative. But in the logistic, the result will be 1 or 0. That is the difference. Straight line, you can go down like this, unlimited. But in logistic, it is caps on 1 and caps on 0. Capish, Yolanda? Okay, any other question?
In the slide before, just one slide before.
This
yes. One? Next one.
This one?
We were talking about, yeah, the forecasting of the effect.
The forecasting. Okay.
Uses of regression.
Yeah. What about it?
The forecasting of an effect, you mean to say that effect is either on the XY positive side, that what you explained in the just now, or yeah, it will be effect, is it positive and negative, both, you mean to say that?
Okay. So the trend will be like this: positive relationship, negative relationship. When it is y equal to constanta plus beta x, it will be positive relationship. But if the resulting model is y equal to minus c minus dx, or plus c minus beta 1x1, can be negative, because the result will be negative, and this one the result is positive. Araso, Bendu.
Okay. Thank you.
Got it? All right. Any other questions? Okay.
Jadi,
yeah.
In a simple word, so when we are building, let's say, the score, like a credit score,
open cam,
so we are using
open cam nih.
Okay, Pak.
Okay.
So when let's say we are building a credit score.
Okay.
So the type of regression that we should use is linear regression, right? Because there will be like continuous.
No. Credit scoring will be logistic regression.
Oh, oh, why is that, Pak? Because the value only good or bad, or
Yeah, that's why. Because in in the linear regression, we calculate continuous variable. You can calculate the amount of credit, continuous variable. But in the
oh,
risk management or mostly using logistic regression, because you're gonna see whether it is default or not default, isn't it?
yeah,
One,
but
then zero.
sometimes,
So how big is the probability that the customer going default and not default?
mm,
Rasa?
mm. But sometimes like the score itself, they have like particular score number, Pak. Let's say 500, like FICO score or
Yeah,
S&P score.
that is only or that score is only what we call that? Rounding up. No, I mean, so let's say the y is 1 and 0 on the logistic. Yeah.
Mm,
So we got the coefficient, and then the coefficient interpolate into a bigger number. Let's say times 100, times 50. So the score becoming the score is going to be there, because the coefficient you times the score with the 100. So let's say the coefficient like this. The y is constanta plus 0.5 times h plus 0.3 times salary. So 0.5 and then you times 100 become score will be 50 on h, 30 on salary. So that is the score rounding up times 100, something like that. Araso nining. On the
okay.
logistic regression.
Okay, Pak.
We
So
will
for the,
we will
let's
discuss
say
it
for the,
next week on
oh,
this.
okay, okay.
Be
Thank you,
patient.
Pak.
we going to discuss detail next week on the logistic. Tonight we are going to discuss on linear. Any question on linear regression ini?
No, Pak, it's clear. So for like, say for score like loan size or loan amount,
Yeah.
so it will be linear, right, Pak?
Yes, linear regression.
Okay. Okay.
All right, cool. Any other questions? No question. Okay, I continue. Okay. So, linear regression is a method to predict dependent variable based on the values of independent variable. It can be used for the cases where we want to predict some continuous quantity. Credit granted, salary, yeah, depend on the, let's say, depend on ages, and then the ages, education, blah blah blah. This one is the salary, experience, how many company you've been through. Then you predict the salary of the individual. And then on the linear regression selection criteria, so there is classification and regression capabilities. So you have to check on the data. If the data is using the classification data, sometimes like like job. Let's say the job is employee, and then the job is what is the farmer, and then soldier. So there is we cannot do this in the regression. We need to change it into dummy variable. We put here employee, farmer, soldier. 1 0 0 0 1 0 0 0 1. This is how we deal with the classification data or categorical data. Yeah. So we do what we call is dummy variable. Okay. And then the data quality. Yeah. So make sure on the data quality there is no missing data. Yeah. If there is missing data, you can deal with that using the mean or median. You can input with the mean or median, but I usually use the median. Because if there is outlier in the data, the mean can be very biased. Yeah? Usually I use median. What is median? 1, 2, 2, 2, 3, 3, 5, 6, 6, 7. What is the mean? The mean is the total divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 by 10. What is the mean? 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, or say, let's say 8. 1, 2, 3, 4, 5 is 1. 3 is the median. So I usually use median to input the missing data. Let's say the salary is empty. What is the median? Because on the salary, if you use mean, can be very high or can be very low. Yeah? Depend on the data. But if the median, it is in the middle. Data quality. And then computational complexity. Yeah. And in the regression, there will be computational complexity. Yeah. We can use Python, R, SAS, SPSS, a lot of computational program to handle regression model. And then it is comprehensive and transparent. In linear regression, there is no black box. There is explanation on the result. There is significance on the p-value, on the t-statistic, so it is transparent. There will be p-value. There will be t-statistic. There will be coefficient on the beta. There will be r-square. So this is very transparent. You can explain, you can interpret the model because you can interpret the model very well because the data is there. Yeah. So that is on the selection criteria. Where is linear regression used? We can use linear regression to evaluating the trend and sales estimates. Yeah. In the financial, you can estimate sales using the linear regression. Let's say year 2015, 2016, 2017, 2018, 2019, 2021, 2022, 2021, 22. So you want to estimate how much is the sales if there is numbers here. How much is the sales? What are the and then you can develop the data. Let's say the sales, and then there is what is the x1, x2, x3. Maybe this one is on the machine. This is the man. and then machine, money, yeah, meaning, whatever. So, and then you compute the regression model. You can identify the model y is equal to constanta plus beta x1 plus beta 2 x2 plus beta 3 x3. So, given in 2021 with the x1, x2, and x3, how much is the sales? So you can estimate the sales using regression model. Also analyzing the impact of price change. Yeah, price change. Okay. So if you increase the sales, if you increase the price 5% or 10%, you increase the price. Yeah. And then you increase the price 20%, you increase the price 30%. Okay, let's see like this. Price increase 10%, price increase 20%, price increase 30%. This is the, what is the sales? Product A, product B, product C. And then the product is 1, 2, 3, 4, 5. And then this one is 10%, 1, 0, 0, 2, 0, 1, 0, 3, 0, 0, 1, 4, 1, 1, 1, 0, 0, 0, 1, 0, something like that. What is the sales? Yeah. So y is equal to constanta plus beta 1 x1 plus beta 2 x2 plus beta 3 x3. So you got the coefficient here on each of the sales increase, price increase. Okay. So given if you increase the product in x1, yeah, you put 5 product here, 3 product here, and 2 product here, what is the sales? So that is the analyzing the impact of price change. If you increase 30% towards 100 product, and then you increase 20 product with the 20%, what is the impact on sales? So these can be done in the linear regression. Up until now, any question? Any questions? No questions. Let me show you a demo using Excel. Okay. So this one not using Python yet. So this one is using Excel for you to better understand. Oh, I think after I finish the theory first, yeah. Later on. Oh, but no worries. Let's say ages here, and then edu here, and then salary, and then edu, and then dependencies, dependent, and then the year of experience. This is the salary. Okay, this one is run between 1 to 5. And this one is the salary, run between, let's say, 10 million until 50 million. And this is the data. Okay, there is data analysis here, And then regression. This one is Y range. This one is X range. And then you put label because you have label here. And then you have the output beside it. So, okay, so this is the using Excel. If we use the regression using Excel, yeah. So we have the coefficient on the age, coefficient on the education, coefficient on the dependence, coefficient on the year of education. Yeah. So there will be Y equal to the salary is equal to minus 1992347 toward age. Coefficient first. Coefficient plus beta minus 1. Coefficient is 29, yeah. 29194 29194 689 minus 1992347 times the age minus 2901043 times the edu minus 8097110 times the dependent plus 1118671 plus 1118671 times year of experience. So this is when you have the data like this.
Why you keep minus in edu? Edu is positive coefficient.
Edu positive, positive. Oh yeah, minus, possibly positive. Okay. Edu plus. Okay. So the concept is, let's say you have another new data like this. 1, 2, 3, 4, something like that. So the data changed, no worries. So how much is the salary? Equal to constanta plus 1 times age plus B times edu. Oh no, number 2 is edu plus C times coefficient of dependent plus D times year of experience. This is the salary. Yeah. 39 million. 3 million something. 3 million. No, 39 million. Yeah. So this is the salary. So this is the data is continuous data. Yeah. This one can be continuous, can be liquor, can be anything. You just, the point is that Y is the continuous data. So far so good. Araso. So we have the coefficient on the result of the regression. Yeah. There is p-value. If p-value is below 0.05, it is significant. So there is no data significant because this is DABI data. Yeah? And then the t-statistic is, p-value supposedly below 0.05. And t-statistic is above 1.96. Only one, no. This one not, so no data is significant because if only one is significant, it is not significant. Supposedly, if p-value, if the p-value and if the data comply with the p-value below 0.05 and t-statistic n, not or, n, t-statistic is above 1.96. 96. None of the data is significant. Maybe if we put here something like this, 0.002, 1.9697. Okay. So only education is significant. 2 with the relationship with the salary. If the education is high, salary is high. Education is low, salary is low. Something like that. If only which determined by the data which has significant if the data has a significant variable that comply with the low p-value and high t-statistic. Araso. Any questions?
Jerry?
Yep.
Can you also share this Excel, Pak?
Sure. I will share this. Yeah. So this is the Excel model, not the Python. Yeah. This is to determine the concept of thinking, the way of thinking on developing the linear regression model. Okay, continue back to the slides. Yeah. So we analyze the trend and estimate the sales. So in understanding linear regression, given that you had my demo on Excel, so the line will be linear, something like this. Yeah. This is what we call linear model. Y equal to constanta plus beta x. Yeah. There will be data here. Yeah. Given the data with the coordinate of data. Yeah. And what is the error? The error is the distance between the coordinate and the line. This is what we call error. This is the error with the actual value. Yeah. The actual value is here and the line is there. So there is error on that. So, and this is, the coordinate is x and y. X is the independent variable. And y is the dependent variable. If it is linear, if it is single linear model, linear regression, there will be something like with the array 2.3, 3.5, yeah. So this is the data. This is 2 dimension, yeah, x and y. So this is the linear regression on the single linear model. So, okay, so let's say that understanding the linear regression algorithm, you have the x and y like this. If you have the x is 1 and 3, 2 and 4, 3 and 2, so what is the model will look like? Will look like this. Yeah. 1, 3, 2, 4, 3, 2, 4, 4, 5, 5, yeah. So this is the coordinates of the data. Okay. And what is the mean? So there will be center of the data. What is the center of the data? Using the mean. Let's say 1 and 2 and 3 and 4 and 5. 3 plus 3, 6, 6, 10, 15 divided by 5, 3. So there will be 3 here as a mean, and 3, 4, 2, 4, 5, 7, 9, 13, 13 and 5, 18. So the mean will be 3.6. This is the centroid of the data. The centroid. Yeah? And then this one. Okay. So we would like to calculate the beta, the M. So M is the beta here. As a beta. So what is the formula? M equal to covariance. Covariance of the two variable divided by the variance. What is the covariance? The covariance is the relationship between X and Y, which is X minus mean of X times Y minus mean of Y. This is covariance, relationship between two variables. What is variance? Variance is the X minus mean of X as the independent variable by the power of 2. So when you divide covariance and variance, you determine beta. So this is the explanation of beta, how the computer calculate the beta. How the machine learning calculate the beta. They determine the covariance first, divide with the variance. So this is the model. So this one is X and Y. Okay, we use the single linear regression first. Mean is 3. Y mean is 3.6. X minus mean of X minus 2, minus 1, 0, 1, 2. Y minus Y means 3 minus 3.6 minus 0.6, 0.4. Okay, this is the variance. X minus X means by the power of 2. X minus 3 is 2 by the power of 2, 4. 1, 0, 1, 4. What is the covariance? X minus X. 1 minus X means minus 2 times Y minus Y means minus 0.6. Yeah. 1 minus 3 minus 2 times Y 3 minus 3.6, 0.6 minus, which is resulting in 1.2. So we got like this. And what is the sum of the covariance is 4. What is the sum of variance is 10. So beta will be the coefficient, or beta or M in this slide will be covariance divided by variance, equal to 4 divided by 10, 0.4. So far so good. Any question until this slide on how to calculate the beta? Araso? Any questions on the beta? No question? Yes, Irwan?
No question.
Okay, good. And then, what about the constanta? The constanta, when we have the beta 0.4, we put it here. And then the X mean is 3, we put it here. And then the Y 3.6, we put it here. The constanta will be identified, which is 2.4. So in the we identify the beta and the constanta. And what is the model? Y equal 0.4 times X plus the constanta, 2.4. So far so good. Any question until the slide? How to understanding how to calculate the beta and the constanta. Any questions? Araso? Araso?
Sorry, Pak Jerry.
Yes.
Can you repeat the constanta, Pak?
The constanta, after you identify the beta, 0.4, you put it here. The x mean is 3, you put it here. And then the y mean 3.6, you put it here. What is C? C is 2.4. 0.4 times 3, 1.2. 3.6. Y constanta will be 3.6 minus 1.2, 2.4.
Okay, got it, Pak.
Okay. Good. So we identify the model. All right. Okay. So when we identify the model, we can use the model to the testing data. Yeah. This is the model. And given with the x is 1, 2, 3, 4, and 5, the result of the y is 2.8, 3.2, 3.6, 4.4. Yeah, just like what I did in Excel. Given the x age, let's say they have the 1 year experience, something like that. Their salary 2.8 million. If they have two years experience, their salary 3.2. If they have 3 years of experience, salary 3.6, something like that. So the model will estimate the salary of the employee. Yeah? This is the estimate, the prediction. This is predicting the salary. Yeah? This can also be done to the, because in a bank, the salary is not updated only when they open the account. Yeah, when they open saving account, they say put the salary 5 million. In the next 10 years, we don't know. So we need to predict how much is the salary of the individual. So we can use a regression model to identify that. And then there is prediction and there is actual. So there will be error between actual and prediction. Let's say this one is red is the prediction, green is the actual. There will be error on the data, not accurate. Yeah. So R-square is the statistical measure of how close the data are to the fitted regression line. Yeah. So R-square determine, let's say, determine the actual and prediction. Yeah. So R-square is the statistical measure of how close the data to the fitted regression line. So this is R-square. Where is the line? Something. So supposedly there is a line here. Yeah. So this one is the line. So how close the data to the fitted line, or also known as the coefficient of determination. So that is R square. In the other word, R square represents, the R square will be in percentage, yeah. The R square, let's say the R square result is 80%. It means the data the data represents 80% of the data represent 80% of the accurate model, yeah? Meaning that there are another 20 more data. Let's say this is the variable represents 80% of the accurate model. There will be another 20% which is not in the data, not in variable, yeah. Because there is errors there is distance between the actual and the prediction. So if the data, the non-accuracy, the representative of the data will be determined by the R square. So if there is only 30%, so meaning that the variable only representing the 30% of the variable population. If the R square is 80%, meaning the variable that we use represent 80% of the total variable population. The higher the R square, the better. If the R square is low, it is not good, meaning the variable only represent small amount of variable population. So far so good. Until this slide, any questions?
If R square is 50%?
Come again, Bendu?
If R square is 50%, but
50%. 50% meaning that all variable in the model represent 50% of variation population. Meaning there is another 50% of variable not included in the model. Araso, Bendu.
Meaning this is not a good model, something like that, is it? Because 50% is not known. It is like still not a variable.
Not really, not like that. The R square for the, let's say for Nining case, for the consumer behavior, 50% is considered high for consumer behavior. And then for marketing, supposedly around 70% or 60%. But for the finance, supposedly around 80%. So depend on the function. Eh? If it is on the consumer behavior, 50% is strong enough. Consumer behavior. But if in marketing, we need to be more accurate. 60, okay, consider high. In finance, around 80%. We need to be sure, yeah, whether, let's say in economics, whether all the variable, inflation, and then the oil, and then the balance of payment, etc. So we need to be around 80% R square, because this is regarding the money, yeah, budget deficit, we need to borrow money to the using the bond, something like that. So we need to be more in the R square. The data is representative enough to develop the model. Araso Bendo.
When it comes to healthcare, let's say we are talking nowadays about COVID.
Yeah.
There are also percentages, right? That every day there is a decrease of this much percentage, and patients are getting better, or the other side. Oh, yesterday it was like 10% increase, but today it rise to 40%.
Okay.
There is a slight. In that cases, then how? Because if it is COVID, we are seeing the negative side. Let's say we are seeing that the country is going towards doing good towards COVID, like they are having people vaccinated, or they are having means they are protecting the people so that the cases are not going up, because that has to be again on the lower side, right? What we see on the graph and on the paper, but or it is not being R squared.
This one, the R square is about variables. Let's say you have ages. What is the variables? There is dependent variable and independent variable. Independent variable is there. You have 5 independent variable. You have 10 independent variable. You need to understand, is this 10 variable representative enough for me to develop the model? Meaning, is there any other variable not in the 10 variable? So that is what R square tell us. Okay, the R square is only, let's say in here. Let me put here. The R square is only 41%. So the age, education, dependence, year of experience only cover 41% of the supposedly included variable due to the errors. Because this is the salary. If you put the model towards the data, it will tell you different result. The accuracy is very low, something like that. Okay. So let's say this is the error. The accuracy minus. So this is the error of the data. So the R square telling us, okay, the data you have here only represent 41% of the total variable that supposedly put into the data. Are you okay with that? Only 41%, the R square, the representative of the variable? If you okay, go. If not, you need to find another variable which represent the relationship with the dependent variable better off. Got it, Bendu?
Okay.
Okay. Any other questions?
Okay, question.
Yes, Irwan.
Okay.
So what is the difference between the R square and adjusted R square? Which one we should use?
I use R square.
Why is that?
What is the adjusted R square? So it is adjusted, meaning that this one. Okay. So with the adjusted R square, okay. So there is a model with the intercept and with non-intercept. Yeah? Adjusted R square when you do not use intercept there usually. Yeah. when you do not, so there will, okay, there you will see that in the logistic, yeah. So there is two kind of model. One model with the coefficient, one model with no coefficient. So just using the coefficient of the variable. Yeah. In that one, you can see the it is using the adjusted R square. Yeah. Let me explain in another way. Yeah. Okay. What is adjusted R square? Adjusted R square. Adjusted R square is a modified version of R square that has been adjusted for the number of predictors in the model. The adjusted R square increase when the new term improve. The adjusted R square increases when the new term improves the model more than would be expected by chance. It decreases when a predictor improves the model by less than expected. Yeah, so this is another yeah. So this is okay. Yeah, this is the formula to calculate the adjusted R square. Yeah. So what is so this is a modified version. Yeah. What does the R square tells you in here? Okay, it tells you whether the adding additional predictors improve a regression model or not. Oh, so if you put another, yeah, okay. What is the difference? Every time you have R square increase, okay. Even if it never decline. Whereas adjusted R square increase only when independent variables is significant and effect dependent variables. Oh, okay. Like this. R square also include the
Insignificant variable.
yes. And the adjusted R square only using the significant variable.
Oh, yeah, I get it.
Okay. So in here, all variable 41, but the significant one only because there is none of them is significant. Yeah, none of them is significant. So the adjusted R square, oh okay, my god, none of them is significant. Only 0.02, meaning 2%, meaningless.
Yeah, betul.
Araso, Iwan. Okay, good.
That's all, thank you.
Okay, any other questions? No questions? Okay. I heard before Nining. Yes, Nining.
So when we found out that the R square is, let's say, low, then what should we do, Pak? Do we need to change all of the variables or only certain part of variable that we need to change?
Depend on the result. So let's say in here, none of the variable is significant, is it? So that's why the R square only telling us the significant variable. None of the variable is significant. None of them representativeness. None of them were representing the Y variable. Yeah. 41 is including the non-significance. So the non-significant gives 41% of the non-significant. So the next action is to drop all the non-significant variable. Use only the significant. Let's say edu is significant and dependent is significant. So you develop a model, drop the age and year of experience. You create a new model again, only with the significant model. So this is the feature selection. I explained to you all before, yeah. The feature selection. Oh no, yeah. So Yes, the feature selection. Yeah. So in feature selection, you select based on the significant one. Not significant, you don't put it in the equation. You drop that from the equation. Arason ini.
Harusnya.
Okay. Good. All right. Till when? Okay, this one. Right. So, how to calculate the R square? And then, okay. The R square is the Y prediction minus the Y means by the power of 2 divided by the Y actual divided by Y means by the power of 2. What is the Y means? The Y means is the means. Yeah. The Y means. Yeah. Okay. So let me check this one. Let's see the X and Y coordinates 1 and 3. This is the data. Okay. And then this is the Y prediction. Yeah. 1 and 2.8, 2 and 3.2, 3 and 3.6, 4 and 4.0. So this is the Y prediction. This is the Y actual. Wait a second, where's my pen? Where's my pen? Pineapple. Okay. This is the Y actual. This is the Y prediction. Given the X. The X is still there, yeah. The changing variable is only the Y prediction, yeah. Yeah. So when we put the model Y equal to constanta plus beta times X. So we have the new Y, predicted Y. So the R square will be the sum of Y prediction minus Y means. Yeah, which is here, and then by the power of 2 is 1.6. And then Y minus Y means by the power of 2, 5.2. So the R square will be 0.3. This is how we calculate the R square. Okay, so far, any questions? Any questions before we continue to the Python? So far, so good? Araso?
Pak Jerry, sorry Pak.
Ya, ini.
So the R square is a similar or not Pak with the mean square error?
Mean square error?
Because mean square error is like also like the distance Pak between the mean.
Yeah. I know. So what is the difference between R square and, so this is new question, okay. R square. Difference between R square and mean square error. Yeah. Okay, this is different then. But it quantify how well the regression model fits a data set. mean square error tell us how well a regression model can predict the value of the response variable. The value of the response, while R square tell us how a model can predict the value of the response variable in a percentage term. Oh, R square in a percentage term. Mean square error, how well the regression can predict the value in absolute term, absolute, not in a percentage. That is the difference. Let me see here. We have mean square error kah? No, you don't have, yeah. Mean square error. Only standard error. The distance only. Yeah, we don't have. Okay, Nining? Araso, Nining?
Okay, Pak.
Okay. Good. Any other questions on the until the last slide here? No? Okay, let's continue to the linear regression using the Python. Okay. Wait a second. We're not here. This one. Oh, okay. Simple linear regression. So I share it to you. Share with the public. Save. Okay. We have simple linear regression and multiple linear regression. Let me share it to you. We have two. You can copy. How to copy that? Using the edit, yeah, this one. Supposedly there is, if you open the file, there is copy and edit, yeah. So that will be automatically bring to your data. Okay. So in this demo, I would like to use Yahoo Finance data, finance.yahoo.com. So this is financial data analytics. Yeah. I think you already, okay. This is financial data analytics. The objectives is that we would like to calculate the cost of capital or capital asset pricing model. So this one, I think I need another 10 minutes to explain to you. So this is using the corporate finance chapter 14, cost of capital. Yes, Jolanda? Yes. Okay. Okay, so what is the cost of capital? Cost of capital is how to determine a firm's cost of equity capital. Yeah. So, and also cost of debt. Cost of equity, cost of debt. Meaning when you have a if you have a stocks there, you want to identify the cost of equity capital using stocks. So you want to calculate the cost of equity capital using stocks. If there is debt, so you want to calculate the cost of debt. And you also want to determine a firm's overall cost of capital. Yeah? Let me, okay. Why cost of capital is important? Yeah. We know that the return on asset depend on the risk of those assets. Yeah. So when you want to finance your business, you may finance it from debt or from equity. Yeah? There is a risk on that. Yeah? So, to understand, okay, let me speak with another language. Okay. So, when you want to invest some money into a stocks or into a project, you want to calculate the present value of your investment, which is what we call present value. There is, let's say you put investment here, you buy machineries, etc. There is cash outflow there, 1 million US dollar, and then cash inflow, yeah, cash inflow. Let's say $300, $300, $300. The present value of your investment equal to minus $1,000 plus 300 divided by 1 plus R by the power of 1 plus 300 divided by 1 plus R by the power of 2 plus 300 divided by 1 plus R by the power of 3 plus 300 divided by 1 plus R by the power of 4. R is the return, expected return. So we would like, in the cost of capital, we would like to calculate how much is the expected return that we need. How much is the expected return to calculate the present value of a project? The expected return can the expected return can be from the debt or can be from the equity. From debt meaning that we borrow money, so we release bonds. We release bonds to the market. Yeah? Or from the equity meaning that we release IPO, initial public offering, to finance our project, which is here, minus $1,000. We need money from debt or from equity. If from debt, we call it cost of debt. If from equity, cost of equity, which is capital asset pricing model. In equity, the other jargon is what we call capital asset pricing model for the equity. So, this is what we are talking about on the cost of capital here regarding this project with Python is regarding the capital asset pricing model, CAPM. Okay. So the expected return is the same as the appropriate discount rate. Discount rate, yeah, is based on the risk of the cash flow. Yeah, because it is as a discount rate, discounting, yeah, divided by 1 plus expected return by the power of 1 because this is year 1, this is year 2, and this is year 3, etc. This is year 1, year 2, year 3, year 4. That's why this is with the power of 1, the power of 2, power of 3, and power of 4. Okay. Up until this slide, any questions? So far so good? Araso? Okay. Okay. Let me go into the capital asset pricing model. Okay. So, the expected return, yeah. Okay, okay. The expected return for the discounting rate for the cash flow, if you use the capital asset pricing model, the model is like this. Return on the equity, expected return on the equity equal to risk-free asset. What is risk-free asset? Risk-free asset is the asset which has no risk at all. What we call SUN. Surat Utang Negara. Government bonds. That is risk-free asset. Supposedly, yeah. Government bonds. Because if it is fail, then the company is bankrupt. So, the risk-free asset is SUN. Currently, Indonesian government bonds is around 5% per year, the return. Let's call it 5%. Plus beta. The beta of the market. Yeah? Of the market minus the risk-free asset. This is the expected return. Okay. Let's say you want to invest your money in Mandiri stocks, BMRI. The risk-free is the SUN, 5%. The beta is the covariance. Yeah. The beta is the covariance between Jakarta Stock Exchange and Mandiri divided by the variance of the Jakarta Stock Exchange. Covariance between Jakarta Stock Exchange and Bank Mandiri stocks divided by variance of Jakarta Stock Exchange, because you want to put expected return on Mandiri minus the risk-free 5%. Yeah. So this is the concept of the capital asset pricing model. The beta will be the covariance between Jakarta Stock Exchange and Mandiri divided by this is Mandiri and Jakarta Stock Exchange divided by Jakarta Stock Exchange variance. Yeah. Okay, so that is the concept. Now we would like to calculate. We want to get the data to calculate the capital asset pricing model or the return on equity, return cost of equity, yeah? The return on equity or capital asset pricing model or cost of equity. It's just the same. Yeah. All right, let's get the data. So we open the Yahoo Finance Yahoo Finance, and then find the Jakarta Stock Exchange. Jakarta Stock Exchange. Okay. And then go to the historical data. And then you want to see the monthly close data. Monthly close data, and then apply. So you can see that the monthly close is this. Wow, it is breaking the 7,000, yeah? So closing on March 30, 7,050. March 1, okay. So this is the data for 1 year. This is big data, if you want to see the period more than 1 year, yeah, you can see 5 years and so on. You can do it later on. So apply, download the data, and then you put it here, save. Okay, this is Jakarta Stock Exchange, and then let's say BMRI, Mandiri. So BMRI, this is the historic. We want to see the historical data. Come. Okay, and then you want to see it by monthly. Apply. So this one is the data. Okay, Mandiri price closing 7875 today. Quite high. Download the data. You can put it back here. Okay. All right. So you have two data. BMRI and Jakarta Stock Exchange. So let's open the Excel. Open file. I already have the data. This one kah? 3 stocks kah? Okay, this is the close price of the data. Yeah. So in the capital asset pricing model, we want to calculate the return. What is the return? Okay, so will be in Telkom, the new price minus the previous month price divided by previous month price. Okay, this is the data. Okay, we have the return on Telkom, Jakarta Stock Exchange, and Mandiri. 3 stocks. So I want to use only this one for the single, for the new single linear regression. Oops, sorry. Okay. Yep. So this is the return. Okay. Okay. So let's file save as. This is the 2 stocks. Comma delimited. Let's name it 2 stocks. Save file. Okay. Yep. Okay. 2 stocks. Okay. Yes. Okay. Come again to the simple linear. Okay. Actually, I already put the data here, but not the return, yeah. Only the price, the closing price. So let's add more data. Upload the data on the return of the stocks by monthly. Central Queensland, FBA, PPTs. The two stocks open. Two stocks. Create. Close. Is it shared yet? Oh, it do it again. Success or not? Let me check. Is it uploaded yet? Not yet kah? For a second. It's running. Add data. Upload data. Okay. Two stocks. Open. Two stocks. Oh, already there. Oh, okay. No need. So this is already in the data sets. Okay, cancel. Okay. Skip duplicates. Include duplicates. Oh. Okay. Wait a second. Okay. All right. No, not here. Not yet there. Wait a second. You already copy my Kaggle?
How to copy?
Come again, Yolanda? Already? Okay. Browse. I want to use the return, yeah, not the data. Return to stocks. Open. To stocks 1, 2, 3. Okay, success. Why not come up? Okay. There you go. Oh. Okay. Cool. Copy file path. Okay. So, in simple linear regression, as usual, first we need to import NumPy, SNP, import pandas, SPD, import matplotlib.pyplot, SPLT, and then there is new function here from sklearn, import linear model. So the model is there in the sklearn. What is sklearn? This is sklearn. Yeah, you can search in the Google scikit-learning. The other word is scikit-learning. Yeah? So it is all the models, predictive models, is here in the scikit-learn. So we need to import what model is required for our research. So this one is import from the scikit-learn, import linear model, because we are using the linear model. And then let's use the stocks data. So okay, so currently I use the, okay, let's do the stocks data later on. This one is using yeah, Yolanda.
Sorry, I missed your explanation before how to copy and edit from your Kaggle.
You see above here there is some copy and edit in your Kaggle,
Yeah.
in my Kaggle. Do it. So it will be yours.
Simple linear regression.
Yeah, it will be.
And then how to copy paste into my Kaggle?
Just click copy and edit. It will be in your Kaggle. Happen now? Not yet? Okay, cool. So import linear model. So, and then I run all first. Okay. So first, maybe I use the first data, the BMRI data. So, but I think better off the stocks data or BMRI. So better off the return, yeah. So copy file path first. This is the return. Okay, the return. Okay, okay. This is the Jakarta Stock Exchange data. Yeah. If you can copy and edit from my new Kaggle, and then you can have the data already on the stocks of the two stocks. Yeah. So we have Jakarta Stock Exchange. Okay. So you have data stock exchange and BMRI, the return on months on months, yeah, from the last year March until this March, yeah. So okay, this one is the return on the March 2021 until 22. Okay. Okay. So and then let's plot it. Yeah. Okay, this one is, you don't need this. So I put it here. So run it. Okay. So PX. So there will be X and Y. X is the Jakarta Stock Exchange and Y is the BMRI. So we would like to calculate the capital asset pricing model of the BMRI compared to the Jakarta Stock Exchange. Yeah. And then the X label will be Jakarta Stock Exchange as the independent variable, BMRI as the Y variable. Okay, we have it scattered like this. And then let's call it to the, let's call linear regression. So we put reg equal to linear model dot linear regression, because we already call it from the sklearn that we import linear model, and we from linear model there is options using the linear regression dot linear regression. Okay, and then we fit the model using Jakarta Stock Exchange as X and BMRI as Y. This is data frame double what we call bracket, double bracket Jakarta Stock Exchange, comma, and BMRI as the Y. Yeah. Why we put double bracket? Because this is X, this is Y. Yeah. And then let's do it. Okay, linear regression is there, you can call it. And then what is the coefficient? So this is the coefficient of Jakarta Stock Exchange, the beta. Okay, the beta is, the coefficient is 2.45, the beta. What is the intercept? The intercept is minus 0.0119. Okay, so in this regression model, y equal to coefficient, constanta will be intercept. Constanta is intercept minus 0.011 plus 2.45 times the Jakarta Stock Exchange. Yeah. This is the model that we developed. So we get the beta here, 2.45. This beta is going to be used for the capital asset pricing model. Okay. And then let's, okay, don't need here, don't need this one. So we can see the line here, the line, yeah? The line. And then this one is wrong because this is with the previous model, yeah. Okay. Okay. So when we have the model, y is equal to 0.011 plus 2.5 times the Jakarta Stock Exchange. So Jakarta Stock Exchange is the X. So we can regression predict of the double square bracket of 6,000, meaning if the Jakarta Stock Exchange is 6,000, how much is the BMRI? So BMRI will be 14,723. Yeah. This is the return. This is the return. No. Sorry. If the return, if Jakarta Stock Exchange return is around, let's say, 0.14. What is the return of Mandiri? Will be 33%. Yeah, this is the return, yeah, not the price, not the closing price. This is the return of the Jakarta Stock Exchange. Yeah. If Jakarta Stock Exchange return is 14%, Mandiri will have return of 33%. This is the result. So if you put Jakarta Stock Exchange return is 14%, meaning Mandiri will be 2.45 times 14%. It will give Mandiri return 33%. Okay, so this is one of the alternative to calculate the model, to develop the model and calculate the beta. The other way to calculate it is using the sklearn, using sklearn model and statistical model. So we can import from sklearn model selection, we import trend test split. So we separate the data into the train data and testing data. Train data can be around whatever you want, 40%, 30%, 25%, 80%. And we import stats model. This is to develop the result like what we did in the Excel like this. So Python can also generate this model, this result, using the stats models.api. We import it as SM, statistical model, SM. Yeah. Okay, let's run it. And then we select X. X is data frame dot drop BMRI because we only need Jakarta Stock Exchange as the X. Yeah. So this is the X is Jakarta Stock Exchange. We drop BMRI. And then Y is BMRI or only. So data frame is BMRI. So this is Y. Okay, this is the return on BMRI. Yeah. And then we set the training and testing data, and ye train and ye test data. That is equal to train test split. We already imported it before. Bracket X and Y, comma, with the test size of 0.2. So the training data will be 80% of the data, and testing data will be 20% of the data. So Python will select it randomly. And then in the Python statistical API, there is no constanta if we running it just like that. So we need to add constant. So statistical model dot add constant towards the xtrain. So this is the xtrain underscore statistical model. So there will be another data, constanta and Jakarta Stock Exchange. The default is 1. The default. And then linear regression equal to statistical model dot OLS bracket the Y train and X train statistical model, and we fit the data. Yeah. And then let's call it the linear regression, and we already call it. And then let's print the linear regression summary of our Y train and X train statistical model. So this one is the result. Yeah. So in here we can see that this is the constanta is minus wait a second. This one X train. Oh, okay. Let me run it all again. Alright. Okay. Alright. Wait a second. Is this the same data? Okay. Alright. Drop. And then. Okay. Extract. Okay. Is this the data the same? Okay. Linear regression, Y train, X train. Okay. This is X train SM. This is the data. What about the Y train? Okay, let's see. Y train. Okay, correct. The data is the same. Okay, and then this is the linear regression. Okay, and then print summary of the data. Okay, cool. You just need to refresh it because still be using the previous data. So the constanta will be minus 0.0099. The beta is 2.5612. 2.5612. And then the T statistic is above 1.96. This is okay, significant. P value minus below 0.05, significant. So the data is good, significant. The Jakarta Stock Exchange is significant. So we can use the Jakarta Stock Exchange as the variable, and then R square 50%, adjusted R square 43%, quite good, yeah. And then okay, what is this console? Why console is here? Okay, all right. Okay, why cannot go down? Why the console is here? Okay, wait a second. Why the console still here? Oh, okay. Plus codes. So y equal to minus 0.0099 plus 2.56 times Jakarta Stock Exchange. So this is the model, the resulting model of the capital asset pricing model for the bit so this is meaning that Mandiri gives 2.56 times better than the Jakarta Stock Exchange on the return. Any questions on the simple linear regression using the capital asset pricing model for Mandiri? Any questions? So far so good? Nining?
Still confused.
Still confused. Okay, which one you confused about?
Because I already like late in the beginning. So, yeah. so when it's been like lagging quite some time.
Okay, you can watch it later. Okay, Irwan, are you okay?
I confused about the trend test split, but
Oh, trend test split. Okay,
yeah.
this one is the we import from the sklearn dot model selection. We import the trend test split. The objective is to separate the data into training data and testing data. Okay, so we import the trend test split, and then we develop xtrain, xtest, ytrain, ytest. So there is 4 data: xtrain data, xtest data. So you can check here from here. So what is the xtrain data? Xtrain. This one. This is the xtrain data. And then what is the ytrain data? Ytrain. So this is the Jakarta Stock Exchange data. This is the BMRI data. Yeah, for the train, meaning randomly selected by the Python. Yeah, randomly selected by Python. So this is the index number 6, 9, 5, 2, 3, 1, 8, 11, 10. 6, 9, 5, 2, 3, 1, 8, 11, 10. Randomly selected. Because 20% is test size. 80%, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, 80% is for the training, 20% is for the testing. What is the X test data? X test. This one, 3 data. And then what is the Y test? Of course, also 3 data. So we separate the data into training data and testing data. Araso, Irwan?
Yeah.
Okay.
Pak Jerry, so the test data always lower than the
Your
training.
call. Up to you. But usually yes. Because we need bigger trend data because we need to model we want to create a model. Testing data is to test the model, whether this is accurate or not.
So it's like a control
Yes,
group.
control group. Any other questions? Bendu, questions?
So far, so good.
Okay.
But need to do.
Sachin, I haven't heard your voice yet.
Okay, but now.
Okay. All right. So, okay. So, but we need to create a constanta. Yeah. Because we need to create a constanta, we need to develop new data, xtrain dot statistical model. We add constant in the xtrain. So this is the constanta. Yeah. And then in the linear regression equal to statistical model dot OLS with the ytrain and xtrain dot underscore statistical model, and then we feed it to the model and print the linear regression summary. So this is how you create the simple linear regression. If no questions, we continue to multiple linear regression. So okay, so this one is we need to have another data. So we need Telkom data, Jakarta Stock Exchange return, and BMRI. Okay, this is the return. Okay, let's do this with the 3 data. Meaning, watch carefully. So we have the okay, 3 data. Telkom, Jakarta Stock Exchange, and BMRI. File, save as, PPTs, and then CSV command delimited. Let's put it 3 stocks 1 2 3. Okay. Yes. Close. Save. Yes. Okay. Let's run all. This is the multilinear regression, yeah. Okay. And then add data. So previously I do not use the return. Now I use the return now. Previously using the closing value, yeah. This is 3 talks 1 2 3. Okay. 3 stocks 1 2 3. Create. Okay. Okay, so as usual, this is using the multilinear regression, meaning there are more than one data. We use 2 more X data using the Jakarta Stock Exchange and Telkom. Is there any relationship with Mandiri? Yeah. Okay, so we import pandas, SPD, import NumPy as NP. And then from the scikit-learn, we import linear model, as usual, linear model. And then we read the data of the the CSV data. Read it. Okay, so this is the data. Telkom, Jakarta Stock Exchange, Mandiri. Yeah. Okay, and then we put regression equal to linear model in linear regression. So in the we already input linear model, but we dot linear regression, yeah, on the specific selection, and then rec dot fit the data into the data frame square bracket using two X variable, Jakarta Stock Exchange and Telkom, comma data frame from Bank Mandiri. Okay. Okay, so linear regression is there. And then let's see what is the coefficient. Okay, this is the coefficient of the Jakarta Stock Exchange and this is the Telkom. Meaning Mandiri having lower beta compared to Telkom. Yeah. From Jakarta Stock Exchange is Mandiri is 2.22, from Telkom only 0.104. Yeah. And then the intercept. What is the intercept? The constanta minus 0.01. And then let's predict what happened if the Jakarta Stock Exchange is 10%, 0.111, yeah, 11%, and return from Telkom is 0.16%. So Telkom giving 16% of return and Mandiri giving 11% of return. What is Mandiri return? 27%. If Jakarta Stock Exchange have 11% of return and Telkom 16% of return, then Mandiri will be 27% of return. This is the return. This is the capital asset pricing model for Mandiri. 27%, given the condition. And then from the sklearn, we import again train, test, and split. We import again statistical models.api as SM. Okay. And then for X data, we drop Mandiri because we only need Telkomsel and Jakarta Stock Exchange. So we drop Mandiri. So let's see what is the data look like. Okay. Since we drop Mandiri, the data will be Telkom and Jakarta Stock Exchange. Okay. And then NY is Mandiri. So this is the return. The return on Mandiri. Month by month. And then let's conduct the X-train. Let's develop the X-train model, X-test, Y-train, and Y-test. Using the train test split that model, using the testing size 20%. Okay. And then on the X-train, we need to add constanta. Xtrain underscore SM equal to SM dot add constanta of Xtrain or add constanta in the Xtrain data. So let's see the data will be like this. Constanta, Telkomsel, and Jakarta Stock Exchange. Linear regression equal to statistical model dot OLS with the Y-train and Xtrain underscore SM with the constanta, yeah. And let's fit it to the model. Okay, and then is LR. And then let's print linear regression summary. So this is the model. Let's see p-value. P-value only Jakarta Stock Exchange that is comply with the p-value below 0.05. Telkomsel is not. So Telkomsel is do not have a relationship with Mandiri. Yeah, meaning that Telkomsel do not have any relationship with Mandiri. Did not influence the price of Mandiri. Did not influence the return of Mandiri. So we can drop Telkomsel here because it is not below 0.05. So we can abandon this. R square is 76%, but adjusted only 68%. Yeah, because with the significant only 68%. Okay. Wait. Console. Why cannot going down? What is happening? Okay. All right. So the model will be y equal to minus 0.0192 plus 0.3, 46 times Telkomsel return plus 3.44 times Jakarta Stock Exchange return. But with the condition of Telkomsel is not significantly determine the price, the return of Mandiri. Any questions on the multilinear regression? Any questions? Sachin? Ya, Nining.
So for
Open cam, Ning, yes.
multiple,
Come.
so for multiple regression, Pak.
Mhm.
So the variable will be more than one,
Yes,
Pak.
more
But
than one.
is there any limitation on the
No.
maximum number of
No
the
limitation.
variables? Okay, and then the second one on, can you go back to the predict, Pak? Predict.
Oh, the predict the before ya. This one. What this one?
Yeah, so this number 0.11 and 0.16
Is the
where do we
return
get it?
on the Jakarta Stock Exchange and the return of Telkom. So we would like to calculate the return of Mandiri.
This one is already there in the data set, or we just calculate it,
No.
or we predict it?
Using the coefficient of this one and intercept this one. So you see, you can compare. You can compare. This is 2.22, 24, 2.44. What is the in here? 2 point. Coefficient is 3.44 ya.
Yeah, for
Yeah,
Jakarta
it's
Stock
kind of
Exchange.
different ya, because we use training and testing ya. Because this one is using training and testing. Previous one do not use training and testing. All data as a trained data.
So the number will be higher when we have a training and testing.
Maybe yes, maybe not. Depend on the number.
But it will
Depend on the number. Yeah. But the model will be different because the data is not the same. Yeah. So if you use this model, you can put predict directly of the return of the Jakarta Stock Exchange and the return of the Telkomsel to calculate the return of Mandiri. Yeah. Okay. Any other questions? Any other questions? Irwan, are you good? Jolanda, Giselle, Carmel, Indah.
Will it give the same result with the Excel?
Come again, Camelia.
Will it give the same result like in Excel?
That's it. Excel using the
Regression.
single. Oh no. Okay. So Excel, let's do it here. Okay. This one using the data analysis, regression. Okay. input Y, Mandiri SY, X Jakarta Stock Exchange. This one in here. Label put. Okay. This one is the single model, single linear model. 2.45, 0.01. Let's see in the single. This one is using the testing, but about the one that is using all data. This one, coefficient is 2.45, intercept is 0.01, 245. What about the Excel? 2.45, same. But
intercept Excel is negative.
Yeah,
I think there it is
same, negative. 0 minus 0.011, isn't it?
Yes.
Okay, what about the multilinear? Multilinear data analysis, regression. Y is Mandiri, X will be Telkomsel and Jakarta Stock Exchange. This one. Okay, 0.104, 2.44. I think the same. Let's see it in this one using the full data. 2.44, 0.104. Same kah?
Same.
Yes, the same, Carmelita. You have a good idea, Carmelita. Want to validate the model using the Excel. Cool.
Because I was using Python, Pak.
Yeah. No worries. Just the same with Excel result, But this is MBA data science.
Yeah, I know, Pak.
This is MBA data science. So you need to understand the model in using data science. So any other questions?
So, Pak, what's the benefit using Python, Pak?
Python can Excel is limited raw data, only around 1,000 row. In Python it is billions row. You can do it unlimited.
But if you get the data from the Excel, and then like, if you give the example like previously, you always get the data from the Excel, right? If you want to generate the billion row data like you say,
That is another way. Using API, you connect directly to Yahoo Finance. So using Python, you can connect
can
directly.
it also connect to like Bloomberg terminal, Pak?
Come again, Carmel?
Can it also connect to the Bloomberg terminal?
Winbox, what? Winbox?
Bloomberg terminal, do you know that, Pak?
Blue. Come, I cannot hear you clearly.
Bloomberg terminal, Pak.
Chat.
Oh, chat. Text. You mean text?
Text.
Oh, Bloomberg. Yes, can connect
Bloomberg.
to Bloomberg. Yes, can connect. With Python, we can connect to Bloomberg. We can connect to Twitter. We can connect to Yahoo Finance. We can connect directly just using the API. So basically, I use Excel to make it easy for you because we need access with the API. So we need to request API to the Twitter. We need API to Bloomberg. We need API to Yahoo Finance. So that is required if you want to connect directly to Yahoo Finance. Any other questions? No questions? Okay. So your assignment, okay. Your assignment will be developing. Let me open the file first. Let me check the file first. And then the investment, and then the journals. This one. 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 Okay. Aduh. Wait a second. Okay. Open. Okay. Let me check it. Can you open? All right. All right. Okay. You see the journal here? Yeah, I will send it to you later on the assignment. So your assignment will be developing the investment decision. Develop your investment decision. This is financial data analytics class. Financial data analytics class. So we need to be financially related. Yeah. So you are going to choose which stocks you are going to invest in. Yeah. So you need to develop a decision making using the capital asset pricing model. Yeah. So there are example like this. So there is introduction. Oh, let me see. View, page display, to page. Okay. All right. So I will send you the industry. So everybody will have their own industry. Each of industry has their companies. Let's say automotive industry. In this automotive industry, we need to identify. You need to identify the company first. Let's say Astra International, Indomobil, Astra Autopart, Gajah Tunggal. This is the automotive industry, yeah. And then you need to calculate the covariance and variance to identify the beta. So you do not need to identify covariance and variance. You can identify the beta using the Python. Okay? And then you calculate the capital asset pricing model. What is the capital asset pricing model? Will be risk-free and then plus beta and then return on the market. Yeah, the return on the market is the return on the market IHSG. Yeah, what is the return? And then minus the risk-free. Yeah. So what is the return? Yeah. Okay. So the return on the market will be like this. Yeah. So, okay. Let's say here. No. Not this one. This one, okay. Okay. So, okay. So let's say like this. This one is the average, yeah. The average. Oh, okay. the return of the market will be the sum of his one. This is the return of the market. Yeah, 26. This is the sum of. Yeah. Okay. So risk-free will be the expected return will be risk-free. Risk-free is the government obligation. How much is the government obligation here? Okay, what is the government obligation? The risk-free. This one is risk-free. This one, January risk-free 3.75, February 3.5. So the risk-free mean is 3.55. This is the risk-free. You need to check the risk-free rate now using the government bonds. What is the return, 1 year return? Yeah, and then calculate the beta. Okay, and then you calculate the expected return. The expected return will be risk-free 3.55 plus beta of each of the stocks times in the bracket of the return of the market, which is here. Market will be this one, the sum of the Jakarta Stock Exchange, okay, and then minus the risk-free. Yeah, this one using this one. Yeah, the capital asset pricing model is risk-free plus the beta times the return on the market minus the risk-free. So you get the return. So when you have the capital asset pricing model, you know which stocks you want to invest with, yeah, using the highest capital asset pricing model. So so let's see here. This is the Gajah Tunggal or Auto or Astra International gives better expected return. Yeah. So I will send you these journals for your reference. Yeah. Also, yes, Carmelita.
Can we get the data directly from Yahoo Finance so we don't need to calculate?
You cannot get it from the Yahoo Finance.
Yeah, I mean like you just take it without calculating.
Okay. Another way is using the beta from here. Equal to, what is the covariance? Covariance P from
No, I mean if we just take it directly from Yahoo Finance information, Pak.
Wait a second. I'm explaining how to do it in Excel. Yeah, you need to, maybe you want to validate. Yeah, this is covariance of Jakarta Stock Exchange and Mandiri. Yeah, divided by variance from Jakarta Stock Exchange only. Oh, sorry. Too many view. Itu. Okay. Wait a second. This one is. Okay. Satu mati. Okay. Covariance dari from here. This covariance. Oh no. This one covariance and then comma. This one. Enter. This one is covariance. This is covariance, and then the variance will be variance P from Jakarta Stock Exchange. Okay, this is the beta equal to covariance divided by variance. Araso. So this is a more easier way. Yeah. I show you how to do it in Excel and how to do it in So beta the same kan, isn't it? 2.5 to 45. Araso? Ya. Carmelita.
Iya, Pak. Iya, Pak.
This one is formula text.
Assignment we can do using Excel also. Can
lah, Pak.
MBA Data Science do not Excel Science, ya. So you are entering MBA for MBA Data Science, not SE Sarjana Excel, no, not SA, ya. Not Sarjana Ekonomi, but Sarjana Excel. No, this is MBA Data Science. You need to do it in Python. Okay, so I will send you all the journals regarding capital asset pricing model for your reference.
Individual.
What? This is individual.
group.
I think better off individual first. Yeah. So this is very piece of cake, yeah. Yeah, piece of cake.
Make
For who? For you.
Yeah. So
For me.
okay. So there is okay. There are this one also. So when you are selecting the stocks, you need to calculate which stock gives better return, isn't it? Yeah. When you are selecting stocks, you need to select which stocks gives better return. So this is capital asset pricing model. Yeah. So in here, let's say you have a lot of stocks. You want to calculate the beta. Yeah, the beta. So this one. What is the return? Yeah. So this gives better return. Which one gives better return? So this is the LQ45, 45 company that a blue chips company, yeah. And
how many periods,
how
Pak?
many?
Period.
One period only, one year period.
1 year, yeah. 1 year, yeah. Okay.
So you can
1 year from
yes.
from what point, Pak? Is it from February to
Yeah, you
March?
anytime March 22 until March 21.
Just make it 2021 ya, Pak. The whole
year.
2021.
The whole 1 year.
Yeah.
Yeah, make it monthly, and then.
And then for the stock, Pak, how many stocks that
I give you
we need
industry.
to-
I give you industry, and then you try to find what companies in the industry. What companies are there in that particular industry? So you want to select which company you want to invest your money with. Into
Even though they are not comparables, Pak, I mean like one of them is blue chips and the other one is second liner, but in the same industry.
No worries. Because the point is that which one gives you better return, isn't it? Which one gives you better capital asset pricing model, isn't it? The risk-free times the beta times plus the beta times the return on the market minus the risk-free. Yeah. So this one you can calculate the covariance, calculate the variance, you calculate the beta. So this one is compared to the market, yeah. So Adaro gives which one is highest beta here? Let's say here is Excel minus ke beta. Oh, no. Telkomsel beta very low nih. It depend on the period ya. Oh, Indah Kiat Pulp and Paper gives 2.73 beta. Yeah. And then what is the capital asset pricing model return? This is the beta only, but